Most investors don't fail because they're dumb. They fail because they don't understand what game they're playing. Some people grow their money slowly over 20 years. Others lose it all in 20 days. Same market, totally different results. In this video, you'll learn about 10 types of investors and why some win while others keep losing. As you watch, try to spot yourself, because one of these types might be quietly hurting your money. And the last one? It sounds dull, but it's usually the one that wins. Let's get into it. Type 1. The saver investor. This person hates risk. Fixed deposits, savings accounts, government schemes, that's all they do. Picture someone keeping all their money in an FD for years just to feel safe. Here's the problem. They're not losing money, but they're not really growing it either. Inflation slowly eats it away. It feels safe, it looks smart, but over time it's a quiet loss. So ask yourself, are you protecting your money or slowly shrinking it? Type 2. The speculator. This person doesn't really invest. They just chase fast wins, crypto hype, penny stocks, hot tips. You've seen it. Someone buys a random trending thing because it's going to the moon. It feels exciting, big dreams, quick profits. But honestly, most of it is luck, not skill. And luck doesn't last. Speculators don't build wealth. They ride waves and eventually wipe out. Type 3. The emotional investor. They buy when everyone's excited. They sell when everyone's scared. Think of someone who jumped in at the market peak, then panicked and sold during a crash. That's not bad timing. That's emotions taking over. Fear and greed quietly destroy portfolios. And the scary part? It feels totally logical in the moment. Everyone's buying, so I should too. Everything's falling, I need out. No plan, just reactions. So ask yourself, are you actually investing or just reacting? Type 4. The passive investor. This person doesn't chase stocks. They don't watch the news all day. They just invest regularly into index funds and let time do the work. Think of someone putting money every month into a Nifty 50 fund, no matter what the market does. Simple, boring, it works. And here's the funny part. This boring approach beats most active investors over time. Why? Because they avoid making mistakes. They're not trying to be clever. They're just being consistent. Type 5. The active investor. They pick stocks, study companies, follow trends. They believe they can beat the market. And sometimes they do. But most of the time they don't. Because real skill is rare and overconfidence is very common. You'll see someone spend hours doing research only to do worse than a basic index fund. Hard work doesn't always mean better results here. So ask yourself, are you actually skilled or just keeping busy? Type 6. The value investor. These people look for good companies selling at low prices. They buy when others aren't paying attention. They wait when others are rushing in. Imagine buying a solid company when the market has temporarily forgotten it exists. This approach is calm, logical, disciplined. But here's the catch. It needs a kind of patience most people just don't have. Sometimes you wait months, sometimes years before anything happens. Can you sit still while everyone else is making noise? Because if you can't, this strategy falls apart. Type 7. The growth investor. They go after companies growing fast. Revenue, users, buzz, everything. Think of early investors in fast-growing tech companies. The upside? Huge returns. The downside? If growth slows even a little, the price drops hard. It's a high-reward, high-pressure game. You're betting on the future, and the future is never guaranteed. So ask yourself, are you investing in real results or just in hopes? Type 8. The dividend investor. These people want steady income, companies that pay out cash on a regular basis. Picture a portfolio that sends you money every quarter, like a paycheck. It feels reliable, steady, predictable. But there's a trade-off. More income now usually means slower growth later. So you're choosing.
cash in hand today or bigger wealth down the road. Neither is wrong, but mixing them without a plan is. Type 9, the hybrid investor. This person does a bit of everything. Index funds, stocks, safe assets, maybe gold too. Diversified, balanced, flexible. Sounds smart, right? It can be if it's done on purpose, but a lot of people just mix randomly and end up with average results across the board. No clear strategy, no clear goal.